The fact that I cannot think of a long-term bear case for gold makes me very, very nervous.
Even at $3,600?
Yes. I think we might get a correction, as I said, if Powell tries to act hawkish, although frankly, I think the market takes less and less notice of the Fed.
Yeah.
But if they try to act hawkish, that there might be a correction. Might be a pullback, not a correction. But I find it difficult to think, I truly find it difficult to envisage a scenario in the next 12 months where gold will be lower. And that makes me nervous. Silver, of course, can be a lot more volatile than gold for a lot of reasons, because of the holders of silver. I mean, the central banks aren't going to suddenly reverse course and start dumping it.
The outlook for gold remains unusually strong, with many analysts struggling to outline a realistic long-term bear case. Even at elevated levels, the combination of central bank buying, a weakening dollar, and persistent inflationary pressures keeps the trend firmly intact. Silver, while more volatile, also benefits from this environment, but the real leverage may lie with the mining stocks. Despite gold's 40% rise in the past 18 months, miners have yet to display their typical historical outperformance, suggesting substantial room for upside. AdrianDay, seasoned resource investor and fund manager, has been closely observing these dynamics. With decades of experience analyzing gold, silver, and mining equities, he emphasizes that the current divergence between bullion performance and mining share valuations is striking. While central banks and sovereign buyers accumulate bullion, it is often private and institutional investors who turn to listed companies, creating opportunities when valuations remain historically low. According to Day, the margins miners are generating today are among the strongest in decades, making them one of the few sectors still offering relative value in a market saturated with overvaluation. Now, we present the clips from AdrianDay's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates, and enjoy the video.
If you don't have any physical, you should have some physical, but physical is a savings, physical is an insurance. Definitely the miners, and I'll tell you why. If you look at gold, gold has gone up 40% in the last 18 months or something. The gold stocks have gone up 90%. Mm-hmm. So that's a little over 2 to 1 leverage. Mm-hmm. The last time gold went up 40%, the gold stocks have 3.5 times leverage. We have not seen the leverage that we're used to seeing with the gold stocks. Yes, 90%, no one's complaining about that. It's great. I don't want to...
Short sellers are complaining.
It's great. Yes, short sellers are complaining. But what I'm saying is we still have not seen, because of a dramatic move in gold, I mean, that's a very, very dramatic move in gold we've seen in the last 3 years, a very unusual move for gold. Gold is an asset that shouldn't double in 3 years. And the leverage that the gold stocks have shown so far has been significantly below the traditional leverage the gold stocks have shown to bullion. And the reason for that is obvious. It's because of the people who've been buying bullion, central banks around the world, Chinese non-official buyers, are not interested in buying North American gold stocks. And so the gold stocks have just not had that leverage. So yeah, I think the gold stocks will do significantly better than bullion. The fact that I cannot think of a long-term bear case for gold makes me very, very nervous.
Even at $3,600?
Yes. I think we might get a correction, as I said, if Powell tries to act hawkish, although frankly, I think the market takes less and less notice of the Fed.
Yeah.
But if they try to act hawkish, that there might be a correction. Might be a pullback, not a correction. But I find it difficult to think, I truly find it difficult to envisage a scenario in the next 12 months where gold will be lower. And that makes me nervous. Silver, of course, can be a lot more volatile than gold for a lot of reasons, because of the holders of silver. I mean, the central banks aren't going to suddenly reverse course and start dumping it. You obviously saw the World Central Bank, they have a self-interest, of course, but the World Central Bank survey of central banks. The World Gold Council, sorry.
Yes.
The World Gold Council survey of central banks.
Yes.
And not one that answered the survey said they intended reducing their gold position next year, and about half of them said they intended increasing their gold position over the next year. So the trend, people can change their mind, of course, but I think the trend for central banks is to continue to buy. The trend for the economy in the US is towards an economic environment that is more conducive for gold. You know, a weaker economy, lower interest rates, higher inflation, weaker dollar. That's an environment that is conducive to gold. It's difficult for me to envision, frankly, something that will happen over the next 12 months to make gold meaningfully lower. When do central banks stop buying dollars? But you mentioned Trump policies. That's the thing I want to really emphasize. This move didn't happen with Trump. It's been going on for years before that. We know the weaponization of a dollar. Everybody talks about the weaponization of a dollar as though it started with the seizure of Russian central bank assets, which was, of course, under the last administration.
Yeah.
But it's been going on for years, where the U.S. is increasingly, if I can say it without offending people, increasingly acting as a bully in the world. When you see a Spanish bank, a French bank that lends money to a Spanish company to build a hotel in Cuba, which is legal under Spanish law, legal under French law, legal under EU law, legal under UN law, and legal under Cuban law, for what that's worth. But the US fines the French bank for having the temerity to lend to a company that's investing in Cuba because it breaks US law. And they can enforce that because the bank used the SWIFT code, the SWIFT system. That's just one example. But so what I'm saying is the US has been acting like this for years. That's 15 years ago. So nothing Trump has done has slowed it down or reversed it. But I want to emphasize it didn't start with Trump. Now, that's not a political point I'm making. The point I'm making is that the willingness or eagerness of foreigners to divest from the dollar is a fundamental thing. It's not something they're saying, well, gosh, we've only got 3 more years of Trump, let's just hold on. And it's 47.5% was the last number that came out on the amount of dollars in foreign reserves. We're talking foreign reserves of central banks. So under half. Now, if a reason you're diversifying, you want to diversify away from excessive concentration in an asset about which you're nervous, exacerbated by weaponization of a dollar, the question is, what is too much? Or what is enough? If you're really worried about weaponization, you know, if you're Kazakhstan or, you know, you're a country that potentially is at risk, I would argue anything is too much, right? If you're simply worried about, well, the dollar deficit, you know, the weakness of the dollar because of the twin deficits, maybe 47% is still too much.
Yeah.
So I think we've got a long way to go before central banks say, okay, I'm comfortable with the dollar assets that I hold. And of course, as the dollar goes down, partly because central banks aren't buying anymore and some of them are selling, as the dollar goes down, that only makes a normal person say, maybe I don't want as much as I have. But remember, the really important thing for people to focus on is that U.S. investors, the ordinary everyday U.S. investor, the ordinary everyday registered investment advisor, who's not a gold bug or a gold expert, the family offices, they have only just started moving towards gold. And so when the dentist in Oklahoma calls his broker and says, you know, hey, Joe, I think we ought to have a little bit in gold. And Joe, who knows nothing about gold, and says, do you really think so, Fred? Yes, I really want to. What does he buy? He doesn't buy the stocks that are at this conference. He buys Barrick or Newmont or the GDX. You know, he buys the big stuff. So I think the larger companies still have a lot of room to go. Normally, you're right. Normally, after 3 years of gold appreciation and 90% appreciation in the stocks, those stocks will be overvalued and it will be time to move down. But we haven't had the market participation until just the last few weeks. And if you look at those big cap stocks, they are still good value.
Yeah.
Now, after 90% increase in the price, they're not as good value as they were at the beginning of the year.
Yeah.
But I think we've talked about this before. Remember, you know, Oscar Wilde said people, you know, too many people focus on price and not value. So when the price of gold moves up, the value of the reserves in the ground move up.
Sure.
The value of the production moves up. when the margins expand the way they've expanded, look at the margin expansion. The oil price has not gone up anywhere near as much or is flat.
Yeah.
So the margin expansion has been tremendous. Companies with all-in sustaining costs of $1,850 or $1,900 or $2,000 even, they're making, $1,500 margin. And so your cash flows are going up. Well, when that happens, your price to book value and your price to NAV and your price to cash flow, those valuations don't go up anywhere near as much as the price of the stocks have gone up. And so the stocks, if you look at a stock like Agnico, which is my favorite example, because there's nothing wrong with Agnico, right? You can't say, oh, well, it's cheap because, like you can with, say, Barrick. It's cheap because of Pakistan or Mali. So you look at Agnico and you look at their price to cash flow, right? Their price to cash flow today is a little higher than it was last year. But other than last year, it's the lowest price to cash flow it's been for 10 years. So these stocks on a historic basis, on their own historic valuation metric, are not expensive at all.
The dollar's role as the dominant reserve currency has been steadily eroding. At the turn of the century, it represented 75% of global central bank reserves. Today, that figure has slipped below 50%, with gold increasingly filling the gap as the alternative store of value. This long-term trend highlights the erosion of global confidence in the dollar, both as a reserve asset and as a medium for international trade. At the same time, the Federal Reserve finds itself cornered, balancing inflation, a slowing labor market, and unsustainable debt costs as interest expenses rise simply from maturing bills rolling over. Temporary measures like stablecoin initiatives or reserve requirement tweaks may buy time, but they do little to solve the underlying problem. The real question looming ahead is whether quantitative easing will quietly return to absorb the supply of treasuries as demand falters. Let's get back to the interview.
If we're looking at dollars, the dollar was 75% of central banks' foreign reserves back in 2000.
Okay.
And that graph doesn't show that.
I see.
If you look at the dollar as a percentage of central bank reserves, it's still about 47%, down from 75% at the beginning of the century, in 1999. But, there's no question that the percentage of dollar reserves has gone down dramatically, right? 75% in 1999, 65% 5 years ago, 55% 3 years ago, and now under 50%. So it's been a long-term trend. And I think it's fair to say that nothing Trump has done has stopped or reversed the trend, but it didn't start with him. It's a long-term trend. And similarly, in the last several years, 4 or 5 years, we've had that trend towards higher gold. And again, that's a critical point, because what's happening is gold is replacing the dollar as the central reserve asset, which is part of being a reserve currency. Part of. The other part is being the currency in which trading is done. That's also the percentage of world trade that is conducted in the dollar has also declined, not just this year, but over the last several years. And so even though most world trade is still conducted in the dollar, and even though the dollar is still the largest reserve asset, the trend is definitely, the trend is definitely towards a reduction. And that means that the dollar is not... It's losing some of its reserve status. Well, the Fed is increasingly boxed into a corner, obviously, because of, the mandate to try to keep rates high, to stifle inflation, but help the economy, and particularly the labor market, which is what Jerome Powell seems to be more focused on, the labor market, rather than other aspects of the economy. I mean, personally, I think they should have had a quarter point cut already. That would have helped ease some of the pressure. As I say, they're boxed into a corner, so my sense is that they're going to cut a quarter of a point. And we're probably going to get another one before the end of the year. I'm not sure we're going to see 3 cuts before the end of the year. I'm not sure we're going to see a half point. Some people are talking about a half point next week. I tend to be relatively cautious on that. I would think we get quarter of a point. Powell is still going to talk in the press conference. He's still going to focus on inflation. But clearly, what's happened since the last Fed meeting and the last Fed conference, and the last press conference, clearly the labor market, you can't hide the fact that the labor market is weaker. And I've been saying for months that I think the labor market is a lot weaker than just a headline new jobs and unemployment number would suggest a lot. What I'm saying is Powell, was it 2 months ago now? He kept referring to the labor market as solid. You cannot save it anymore. So that to me is the biggest thing. That's clearly in front of us all. Well, you know, it's as I said, it's just lifting the bonnet or the hood, and you look at the characterization of the jobs, you know, a majority of jobs being government jobs or part-time jobs. You look at people who were accepting part-time jobs, and over 3/4 of people taking part-time jobs had been looking for a full-time job. So all of these things were, and then the other thing was continuing claims. So while new claims were not that bad, I mean, they have been recently, but were not bad, the continuing claims were bad. Yeah. And the length of time it took people who lost a job to get a new job was just getting extended and extended and extended. So those were the things really, just looking behind the headline number, it was pretty clear that it was not a strong labor market. I'm not sure that obviously everything is helpful at the incrementally. It's all helpful at the margin. But I don't think a 25 or 50 is going to do anything for the labor market. 75, maybe does a little bit. I've always said that, that's one of the main reasons that rates just simply have to come down. Because we all know this, or increasingly we all know it, but you look at all of the bills that Janet Yellen issued, and she only issued bills. She issued very, very little at the long end. And so if you've got a 5-year bill or a 3-month bill that was issued 3 or 5 years ago that's coming due now, we've got an average interest expense, I think, now of about little under 3.5%, I think, is the average right now. The latest number I saw. Well, anything that was issued 3 or 5 years ago rolling over today is going to be at a higher interest rate. And so just without doing anything, without extending the terms and maturities or anything, whatever you do, just by the bills rolling over, that interest expense is going to move up. And that's without the deficit going up or anything else. I mean, and as you know, Scott Bessent, the Treasury Secretary, has been using all of the, bag of tricks that Treasury Secretaries use, and he's employed a couple of new ones, the stable coin, what was it called, the Genius Act, to encourage and have light regulation on stable coins that are fully backed by treasuries. No, that's a clever way. That's one way to get more demand for treasuries. How much does that do this year? I really don't know, because you've got to set up your coin. Presumably that takes a bit of time. Sure. You've got to get it through the regulators and get approved, and then you've got to market it. So I really don't know how much you get out of that this year. Let's just say 250 billion to be nice to them. The reduction in reserve requirements on the banks, the whole point of that was to get banks to buy more treasuries. But I don't think banks want to buy more treasuries. They're underwater on the treasuries they own because they're holding them to maturity. They're underwater on what they own. Jamie Dimon, CEO of Morgan Chase, has said he has no intention of buying, or has no interest in buying more treasuries. But again, that was one of the tricks that they were trying to use, reduce the reserve requirement and buy some more treasuries. But maybe that adds, 50 billion maybe. And there's other little tricks and gimmicks that they're using, but they're not getting up. They're not getting close to how much is going to be sold between now and the end of the year. And I think the bigger story than what does the Fed cut rates by 0.25% or 0.5%, the bigger story is, will the Fed institute QE again? They won't call it QE, of course. And Powell has said quite firmly last time, he said, it's not the Fed's business. We don't think about the deficit, he said. It's not our business. That's the administration's problem. That's just, if I may say, BS. Of course they think about the deficit. They might be blaming the others, Congress and the administration, for the deficit, but of course they think about it. And so I think the biggest story is, will the Fed turn to QE to mop up? But in the first half of the year, that was the largest dollar decline since 1973. That's pretty astonishing when you think about it. The largest first half decline in, 50 years. I honestly thought there'd be a bounce. The fact that there has not been any kind of meaningful bounce, there was a little bounce in mid-August, you saw that, and then it quickly reversed. The fact that there has not been a bounce after a big decline like that, and now further declines, suggests to me that the appetite for dollars is very, very weak. And let's remember, for 40 or 50 years, foreigners have been just, until the last couple of years, have just been steadily accumulating dollars. Mm-hmm. You know, and it might be, you know, central banks, but it's also asset managers who were putting, you know, if you're a British asset manager or Swiss asset manager, a lot of your assets are put into the US. And that appetite has gone away. So if they just stop buying, we see a decline in the dollar. But, you know, after you've had to, I'm thinking of it as an asset manager now. You've had, maybe you're a British asset manager and you've had 50 or 60% of your assets in the US. You've got 50 or 60% of your assets in the US. If you buy a US stock, you're buying the dollar, of course, right? You buy the dollar to buy effectively, to buy the stock. You've had the strongest stock market in the world. Yeah. Now you're getting sense that maybe they're not so keen on having us in their market. Maybe you're nervous about the dollar. Maybe you're nervous about the stock market. But for whatever reason, it's not a bad idea to reduce your exposure to the US at this point. And you multiply that across the board. So yeah, I mean, I think the dollar is going to continue to be weak. And remember, the thing is, to the extent that the US loses its reserve currency status, and it doesn't have to, it's not either it's the reserve currency or it's not. You know, that was the way with the pound up until 1945, where we switched from the pound to the dollar. But it doesn't have to be all or nothing. And of course, people smarter than I am talking about the multipolar world and the bipolar world and so on. So the dollar can partially lose its reserve currency, if that makes sense. And to the extent it loses its reserve currency, all of the dollars that have ever been created still exist. But to the extent that it loses that reserve currency, those dollars will start to come back to the US.
Global markets are signaling a loss of trust in dollar dominance, while confidence in hard assets is steadily building. Each policy adjustment from the Federal Reserve may create short-term relief. Still, it cannot disguise the structural challenges of rising debt costs, weakening growth, and the slow shift away from U.S. financial hegemony. For investors, this is not just a matter of watching headlines. It's about positioning portfolios for resilience in a system that is undergoing gradual change. Gold, commodities, and tangible assets are quietly reclaiming their role as anchors of stability, while paper promises grow increasingly fragile. If you found this helpful breakdown, please hit the like button, subscribe to the channel, and share your thoughts in the comments below. Your support helps us continue to provide in-depth, thoughtful analysis to guide you through this historic transition.